I think now we're on a little bit more probably sustainable path, a little bit lower from here. Are we going to go back to the days of sub 3% mortgages? No. In fact, that's the outlier. This is more normal. In fact, you talk to anybody who bought a home in the late 70s and early 80s, and they would have given a limb for what rates are right now. And so if you look at a 30-year mortgage, you're borrowing for 30 years on a pretty large sum of money, and you're only paying 5.5% or 6%. That's a pretty good rate, given recent history and even distant history.
Welcome to the Heart and Home podcast, hosted by the thoughtful leaders and siblings from the third generation of DeYoung Properties.
Hi, everybody. Welcome to the Heart and Home podcast. I am so excited to have you joining us today, as well as the fact that we have a special guest, Brian Ullmann from the Ford Financial Group, one of the managing partners. Thanks, Brian, for being here today.
Thanks for having me.
You bet. And we also have Tim O'Hare with DeYoung Mortgage and Ashley DeYoung, Executive Vice President with DeYoung Properties. All right, we have a ton to dive into today. I cannot wait to start talking about it. Let's jump in. Brian Ullmann is a managing partner at Ford Financial Group, a certified financial planner, and a former attorney who works closely with families and professionals to interpret market conditions and implement long-term financial plans. There has been a ton of news lately about the Federal Reserve, not only the federal chairman, Jerome Powell, but mortgage-backed securities, ton to unpack there. But before diving into those details, let's just take a big step back. How did we arrive at the place that we are right now? Big picture, what's recently occurred at the federal level, on economic level to arrive at this place?
Sure. Well, we can go back a really long way into even 2008, where interest rates were cut to essentially zero, which is where we had really low interest rates and in turn mortgage rates for a very long time. And then we get to COVID, where basically the short version is we had a lot of inflation, which caused the Federal Reserve to raise interest rates. Mm-hmm. And so we had high interest rates for a while, but it became pretty clear in the last year or two that rates were probably a little bit too high for the economy. Inflation was starting to come under control, and so interest rates started to drop.
So that makes sense as though what happened, but how did we get to where we're at right now?
Sure. So even more recently now, interest rates have been going down pretty steadily over 2025, and there's an expectation they'll continue to go down here in 2026 because inflation is under control. And then now on top of that, we have the administration making efforts like funding more mortgage-backed security purchases to allow for more affordability.
Right.
And it's certainly it seems as though this is a focus of the administration right now, affordability generally, and then specifically with housing.
Yeah, I will say in the news almost daily, there's some new housing related topic of an idea being floated, like we just saw a couple seconds ago, using your 401k towards your down payment.
Sure.
Different things like that I think are all really interesting, will be really fun to see in 2026 what actually comes to pass.
Sure. Yeah, the administration is clearly getting creative. And not all of these ideas that are being floated are necessarily going to come to pass.
Right.
But I think what is clear right now is that interest rates are substantially lower than they were even just a couple of years ago.
Yeah, and that's huge news.
Absolutely.
We've seen a ton of excitement in our world.
Sure.
Because of the fact that rates have certainly come down.
Yeah, and I think it's excitement across the board, where high interest rates limit borrowing. It makes it harder to have big purchases, whether it's a home, car. And we're even seeing it with discussions about caps on credit card interest rates, right?
Yeah.
So, I think as we get into 2026, it's less likely that we're going to get the rate of interest rate cut, the speed, and as many interest rate cuts as we had last year, but markets are still pricing in one or two. So I think we can expect that from the Federal Reserve, and that will then flow through to things like mortgages.
Yeah, makes a lot of sense. One of the biggest headlines, and I think one of the things that we were very excited to see, is the fact that they announced a $200 billion mortgage-backed security purchase. Explain what that means and why it matters.
Sure. Yeah. So mortgages are packaged and sold to investors. And so if there's very little demand, to create demand, interest rates need to be higher on those, right? Mm-hmm. They need to earn more interest. If there's a lot of demand, then interest rates don't need to be as high to attract investors. And so when you have the federal government as an investor creating demand, that's going to make it so interest rates don't need to be so high for investors. And that is almost a straight line on a way to get mortgage rates specifically lower. Mortgages are based off of things like the 10-year Treasury rate,
right,
which aren't totally controlled by anybody, the Federal Reserve, the president, anybody. But by creating demand on mortgages, that will push interest rates lower.
Yeah. And does that react immediately, or is that a medium-term or long-term type of adjustment when you see that occur?
I think some of the lag will be just simply the implementation. It's not totally clear how the administration is going to go about doing this and what part of the government will be doing the investing. But I think when it does come to pass, the changes in mortgage rates will be pretty quick.
Yeah, that makes sense. That's exciting.
We kind of noticed it already.
We sure have, yeah.
As soon as it was announced on Friday, I think Tim, you mentioned that it went down 3 times in one day.
Yeah, there was 3 pricing adjustments in one day, which is pretty remarkable. I haven't seen that in quite a while, so that's exciting.
Yeah.
And in fact, actually, I pulled up some stats from Freddie Mac just yesterday, and interest rates from 1 year ago to today have dropped almost a full percentage point. So
to see
that's a huge
big
difference
news right
there.
Yeah.
That's really cool.
Yeah, and I think with borrowers, at least what I see at my firm is that there are also some mental thresholds, right? Where someone says, well, I'm certainly not going to borrow at 7% for a mortgage, but maybe at 6%. And people, when mortgages are at 6%, they say, well, that's still a little high, but once it gets to 5 something, then I'll get off the fence. And so I think as we get deeper into that 5% range, I think that's where you're going to see a lot more demand for houses, people getting off the fence who are maybe otherwise waiting.
And we're going to dive deeper into what DeYoung has in part 2 of this podcast episode, where we talk more with Timmer on that and what we can offer as far as interest rate and what that payment looks like and how it could affect them. So we won't share all the details in part 1.
Yeah, you want to stay tuned for the DeYoung Mortgage segment of this podcast.
Yeah.
All right, well, let's jump into the Fed a little bit here. First of all, is it true that you're being considered for Jerome Powell's seat?
I can firmly deny that is the case.
Darn it. All right. I thought we had an in on that. All right, looking at the most recent Fed meeting, what stood out to you from a market and investor perspective? And looking forward to the next one, how does that set the stage for the next meeting?
Yeah, I think there's probably a little bit more uncertainty with the Federal Reserve than there's been in the past. Usually, or at least in recent years, there's pretty much been unanimous decisions to lower or raise rates, and now there's a little bit of dissent going on in there. And I think what we've seen is cuts happen. Most recently in December, there's some expectation here in the first quarter we'll get another one, but it's not totally clear. Mm-hmm. I think a lot of people are waiting for the new Fed chair to be installed after the March meeting, and there's some expectation among investors that whoever that is will be a bit more dovish, which means they'll be more interested in pushing interest rates lower.
Right, and that will occur in May.
Yeah, so the first meeting of the new chair will actually be in June, so that's where we'll hear from them first. But I'm sure there'll be a little bit of politics going on in between now.
Oh, for sure, because most likely the administration will announce who they're going to select for that role earlier on.
Yeah, I'm almost surprised they haven't done it already. Mm-hmm. That's another way to apply pressure on the current Fed, because you almost would have 2 Fed chairs, so to speak, the outgoing and the incoming.
Putting out their perspectives in the meantime,
Precisely.
And you have to read between the lines between the two.
Yeah, but I think, the president's made pretty clear what his expectations are for the next Fed chair, and so just based on that, regardless of who it is, we can kind of have an idea of what their theory is going to be on interest rates.
Yeah. And I do think it's important to note that the mortgage rates that you would be using for your home purchase are reacting to what is anticipated to occur.
Sure.
So maybe talk about that a little bit. As meetings are coming up, what happens in that world, in that space, as that occurs?
Yeah, so there's not a direct line between what the Federal Reserve does and what mortgage rates are, right? So what the Fed fund rate is what they choose. That influences the rates on the 10-year Treasury note. Mm-hmm. And that's really the marker that almost all consumer borrowing is based on: car loans, home loans, and everything else. And so as the Fed kind of pushes their rates lower, that can help drag the 10-year lower. But some of it's going to be economic as well, right? Where if the economy starts to slow down a little bit, perhaps rates would go lower because, again, buyers need to be enticed to buy these bonds. And so it's not just going to be Federal Reserve in 2026 that's deciding where interest rates go. It's going to be market-based. It's going to be economic-based as well.
Yeah, makes sense. So where are interest rates sitting at today compared to previous highs? What does that mean for the real world in terms of buyers?
Yeah, so just going back to the 10-year Treasury rate, it's been floating somewhere between 4 and 4.2%. In fact, as we're talking right now, it's on the high end of that, about 4.2, but it's really been range-bound for quite a while. And that means rates have come down pretty significantly from where they were just a couple of years ago, but they haven't moved much in these last few months. And so I would say we're probably seeing that with mortgages. You could probably say better than I could with mortgages, but touching below that 6% rate, but not moving a whole lot more below that, I don't think.
No. We're roughly, 5.875. It depends, obviously, on the borrower.
Which is really good compared to these last few years. I mean, it's a huge difference.
How long has it been since we've been to that level, I would say? 2023? A couple years.
Yeah, it's certainly. I would say early 2023, we're as low as we were in early 2023 when we had a blip of rates falling just shortly.
Yes.
I think now we're on a little bit more probably sustainable path, a little bit lower from here. Are we going to go back to the days of sub 3% mortgages? No. In fact, that's the outlier. This is more normal. In fact, you talk to anybody who bought a home in the late 70s and early 80s, and they would have given a limb for what rates are right now. And so if you look at a 30-year mortgage, you're borrowing for 30 years on a pretty large sum of money, and you're only paying 5.5% or 6%. That's a pretty good rate.
Yeah.
Given recent history and even distant history.
Yeah, I think the history shows that if you look at a 30 or 50-year window, average interest rates range between 6 and 8%. Sure. So when you're below 6 and 8%, you're doing pretty good. Yep. And I think especially nowadays, and we'll get into this in the second part of the podcast here, with buy downs or 2-1 buy downs or various incentives that builders are able to offer, you can really get that monthly payment or that interest rate significantly lower than that top number.
Yeah, we're talking a lot of when we talk about mortgage, or at least when I talk about mortgage rates, we're talking about national averages, right? And so when you slice the bologna a little thinner, you can get down in, like you said, with incentives or where things are regionally, it can change the numbers a little bit.
Right. So from a planning perspective, I know you advise people all the time. What's a reasonable scenario in terms of rates over the next several months or half a year? What are you talking about when you're meeting with clients?
Yeah, I think from a personal financial planning perspective, it comes down to not so much the rate, but payment, what you can afford, what you've saved for, right? When personal finance is really personal, right? And so if the rate is 10%, but you found a place that you could afford the down payment on, the payment fits into your budget, you're not having to stretch yourself too thin, then maybe it makes sense. It just when rates come down, it makes more sense for more people, right? That's really what it boils down to.
I often talk about, like, when I'm asked, when's the right time to buy? And my answer is always, it depends on your scenario. If you can afford the monthly payment and you have the need, don't try and time it perfectly. Yeah. It's almost a fool's errand. You can't really ever time it perfectly.
Yeah, I think I don't want to say interest rates are the minor detail here, but if you're basing what you're doing in terms of home purchases on what today's mortgage rate is, that's just one slice of the pie, right? Have you saved for your down payment? Have you calculated what your monthly housing costs, how that can fit into your budget? How much the maintenance cost is on the house? What's the PG&E bill going to be, right? There's so much more that goes into it than just the rate. The rate helps you figure out what your monthly payment's going to be. And then you work into your personal finances from there. And I would say, if anything, home buying, whether your mortgage rate is 5, 6, or 7%, you're still arresting your housing costs to where if you're renting, for example, you have no control over that.
Right.
You can guarantee 10 years from now it's going to be much higher than it is today.
Correct. Yeah. 100% makes 100% sense.
It's nice to have certainty.
Absolutely.
Okay, so how do improving rates and a stabilizing policy translate into lower monthly payments and better affordability? I think we did talk about that a little bit, but any additional thoughts on that one?
No, I think as rates come down, the monthly payment on, let's say a $400,000 house comes down, and it makes it easier for someone to fit it into their budget.
Yeah. So why do windows like this often favor buyers who are prepared and informed? We just touched on that. Yeah. So when you're advising one of your clients, how does that topic come into play?
Yeah, I think it's a great question because it's about preparation, right? You're really preparing your personal finances to get ready to buy a house. For the down payment, what's the monthly payment going to be? And so I think it's important to have the preparation is really the part that you need to focus on. And when you are prepared and it's time, it's probably time to get serious about it. If you think about it this way, rates are lower than they've been. That's great. if rates go materially lower from here, you're going to be competing with a lot more people over the same number of houses, right? So if you are ready, you're ready.
Yeah. If it fits in that monthly payment and your budget that you can afford, like that's what I was saying, if it works, then do it, because you're right. When rates do come down, what's going to happen to sales prices across the board? Yep. Everything's going up.
Yeah, I mean, every economic question is supply and demand, right? And so if you're in that sweet spot right now where the mortgage rate is where you like it, the monthly payment fits what your budget is, and you've prepared yourself financially, it's probably time to start looking.
So I like this question because what we just talked about goes right into this. For someone who's considering purchasing a home, hopefully a new home, what gives you confidence about the direction things are headed right now?
Well, I think a lot of the confidence, not to get back to the personal finance part here, but what should give you confidence is you're planning that you're secure in your job, right? That your future is kind of stable, and that this is buying a home, new home, used home, whatever it is, you're adding to that stability, right? We were talking about arresting your housing costs.
Right.
If you're renting, your rent from 10 years from now is going to be significantly higher than it is today. Whereas your monthly payment on this house that you're about to buy is the same. Right?
Yeah.
So, a dozen eggs 10 years from now is going to be $20 instead of 10, or whatever a gallon of gas is going to be. But your monthly housing cost is going to remain the same because you're locked in.
So are you encouraging buyers right now to consider housing? What are you talking about with your clients in terms of the house?
Yeah, from what I'm seeing a lot more people coming off the sidelines who have been waiting, who really either couldn't stomach or couldn't afford a 7% or 7-something% mortgage. Right. But I think now more and more people are getting serious, and things have been locked up where people are handcuffed to really low mortgage rates from 5, 6, 7 years ago. But also life starts to go on. People start families, people get married, people get divorced, people change jobs. And so some of that movement going on right now is releasing everybody from these handcuffs of these super low mortgages, which were great while they lasted. But people are starting to kind of move and kind of unfreeze.
Yeah, life happens.
Yes, absolutely.
Changes need to occur sometimes. So.
Precisely, and that includes moving usually.
What would you encourage buyers to focus on most when they're evaluating today's opportunities?
Yeah, I think we're getting back to the monthly payment, right? And how that fits in with your finances and how that fits in with your bills, and making sure that you're not stretching yourself too far to where you're putting the groceries on the credit card so you can, pay the mortgage that you maybe stretched a little too far on. And so understanding the monthly payment and where that fits in, and with lower rates, it's going to make it fit in with more people's budgets.
Awesome.
Yeah.
Any final thoughts?
No, we covered a lot. I think we got it.
Awesome. Well, who's going to be the next Fed chair? Will it be Brian Ullmann with Ford Financial Group? You have to find out in a few months. But Ashley, Timmer, Brian, thank you so much for part one here. I think this is a great explanation of where things at in the mortgage world right now in the Fed level. So thanks for coming over. Appreciate it.
Thank you.